everyone, welcome to Finance, and in this video we're going to talk about financial ratio analysis. Now, financial ratio analysis is actually a quantitative method of analyzing the financial health of a company by examining its financial records. It is also known as fundamental analysis. So if you can recall, we have actually a video about stock market investing, and then we have fundamental analysis and technical analysis. Now, yung fundamental analysis kasi, that would, tell you what companies to buy. Yung technical analysis naman would tell you when to buy those companies. So here, we have 5 basic categories of financial ratio. We have liquidity, we have asset management, debt management, profitability, and market valuation ratios. Now, in part 1, we're going to deal with liquidity ratios. So we have 3 examples, medyo madami liquidity ratios, so we are only to focus on the most common and yung pinaka-basic. So we have current, quick, and the net working capital to sales ratio. So the current ratio is actually a measure of the company capacity to address its short-term obligations. So yung formula natin, we have current assets divided by current liabilities. So if we're going to look at the balance sheet of this company, for example, Juan Finance, the total current assets is 790 million, total current liabilities is 200 million, and you would get 3.95 times. So it would mean that yung for every 1 peso current liability, the current assets actually covered 3.95 pesos. Okay, so 3.95 times. Now, as to how good this figure is, hindi pa natin alam. So we just have to compare this figure against other companies' performance or the average performance of the industry. And then saka lang natin malalaman if the company is actually doing good at 3.95 or not so good because of this figure. Second, we have the quick ratio. It actually measures if the company has enough cash. So this time it's going to be the immediate cash to settle its immediate obligation. So this is more stringent compared sa current ratio. Kasi ang kinoconsider lang natin is yung immediate cash. So pag binalikan mo yung formula, it's going to be excluding the inventory. So we only have, in this case, to consider two items in the current asset portion. We have cash and accounts receivable. That's 300 million. And the total current liabilities of 200 million. Here we have the total current asset, 790 minus 490. Inventory, we get 300 divided by 200 million current liabilities, a quick ratio of 1.5%, or 1.5 times rather. So again, for every 1 peso current liability, the company has 1.5 pesos, current asset to cover that, or 1.5 times. Now the last one, we have the net working capital to sales ratio. It measures the company's ability to satisfy its short-term obligations relative to sales. So here we have added the income statement of the company to get the net working capital to sales ratio. Now, net working capital is actually your total current assets minus your total current liabilities of 200. So in this case, we will have 790 minus 200 and divided by the 1,800 revenues. So we will have a net working capital to sales ratio of 0.32. So that would mean that for every 1 peso revenue, the net working capital coverage is actually 0.32. So here we have a way to analyze those liquidity ratios by comparing the performance of One Finance to another company and the industry average. Now, looking at these figures, since they are liquidity ratios, the ideal is that it should be higher. Okay, so looking at this 3.95 higher than 2.5 and 3 or the industry average, so that would give you, a potential decision to buy One Finance. Looking at these liquidity ratios and the rest of the ratios here. Okay, so that would give you a potential buy consideration. Now looking at here, it's the opposite scenario. So you may consider, looking at other financial ratios to examine more when finance. So that's it for this video. Thank you very much for watching, and see you in part 2.